It's an investor's worst nightmare. You buy shares in a company that looks profitable and a few weeks, months, or even longer later, it goes bust. So how can that happen and what can you do about it? Well, the key as an investor is obviously to spot it before it happens. Not much point in being smug after the event if you've already bought shares in a duff company and it's already gone bust. So the key is to look for warning signals. Now, what could cause a company that's making money, looking like it's generating profits, to run out of cash? And the answer is something called overtrading. There are actually several reasons why a company could go bust that way, but it's called overtrading. And essentially it means you stop managing your working capital correctly. If that sounds dull and a bit of a mouthful, it's actually crucial. Many company directors are good at generating profits, not so good at watching cash flow and working capital. Many investors are lured in by a profit and loss account that looks juicy, and they fail to spot that the company is running out of cash. So in this video, we're going to introduce the idea of profits leading to negative cash flow. Sounds a bit weird, but I'll explain in a moment with an example. We're going to look at how that happens and how you can spot it happening and hopefully take evasive action in time. Okay, so going to go straight in with a little example. All right, keep the numbers nice and simple. All right, and at the end, I'll mention a couple of videos where you can get some more information. Okay, so let's take a very simple profit and loss account for a company. Very simple. So let's just say we have a company trading for one period. Now this could be a month or let's say a year, but just one period of trading. And let's say on the back of an envelope, we're not going to do a proper profit and loss account in this video. We have sales, let's say, of 100 million. Okay, so sales are 100 million. And I'm going to ignore, for accountants out there, any opening and closing stock impact. For those non-accountants out there, the assumption I'm about to make is that we only buy as much stock as we can sell before the end of the period. There's no spare, okay, either at the start or the end. So bear with me on that one. Let's say we have purchases, because you can't sell something until you've bought something to sell, if you see what I mean. So let's have purchases of 80 million. Marvellous. This is a profitable firm over this period. Profits 20 million. An accountant would call that a gross profit because it's before overhead costs. All right, we're going to stop there. We're going to say, well, that's good enough. That's trading profitably. We're buying stuff, okay, and then selling it on, and we're making 20 million. And the directors might say to you as an investor, this is brilliant. They might use lots of language to try and make you see how fantastic this is. They might just say profits 20 million, ta-da. Or they might say our margin, here's another way of impressing you as an investor, is 20%. For those who want the calculation, that's simply the profit figure over the sales figure times 100% to give it a percentage. All right, so our gross margin is 20%, and that's pretty healthy, got to be honest, nothing wrong with that. Or our markup is, well, to do markup, you simply take the profit figure over the cost of making your sales, which is purchases in this case. So 20 over 80 million as a percentage is 25%. So however you cut this cake, and the directors might try and impress you a few different ways, it looks good. However, this ignores trading terms, all right? This has nothing to do with cash flow. I'm going to introduce some trading terms to show you how this can actually translate into a rather hideous cash flow picture. This is a small business, so let's assume, number one, the people it's selling to demand a lot of time to pay, generous credit terms. Why? Because they can, because they're bigger than us, all right? And the people we're buying from do the opposite. They want paying quick. Very few of them are prepared to trust a small firm to pay them on time. So let's put some credit terms in, all right? I won't write everything up, but let's assume that 3/4 of our sales have to be on credit. We have to offer credit, so we're not getting paid yet. And let's assume that we're not paid in this accounting period, say first month of trading, all right? And let's also assume that the opposite is true for purchases. So we have to pay for our purchases, 3/4 of them in cash. We can only get, if you like, credit for 1/4 of our purchases. Let's see what that does to cash flow. That is cash in and out, not booking sales when the stuff leaves the front door, okay, when the invoice is issued, but actual hard cash in the same period. So let's introduce that and see what our cash flow now looks like. All right, now remember what I said. We said 3/4 of our customers demand credit. So cash in is, well, that's all right, but cash in is only going to be 25 million. All right, that means a quarter of our customers have paid us by the time we hit the end of the accounting period. All right, and then we said that the opposite problem with purchases, we've actually got to pay for 3/4 of these, okay, by the time we hit the end of our accounting period. So if this is a little cash flow statement running next door, 25 million's come in as a quarter of our sales, but sadly, yeah, 3/4 of that 60 million, of that 80 million, sorry, has gone out to pay our suppliers. All right, and that doesn't look quite so good, okay? Over the same accounting period, we may have a 20 million profit, but 25 million of cash coming in, 60 million of cash going out, leaves us 35 million down in pure cash flow terms, and that's not good. All right, so bit of a problem. If this is a cash flow statement, we've actually got negative cash flow, which probably means we're heading into overdraft, or we're having to approach the bank, or we're having to go into our borrowing, or go back to our lenders and say, how are we going to do this? All right, and if this continues, all right, we could actually go bust quite quickly. The banks might get fed up and say, we're very well making money, Tim, but where's the cash? All right, we're getting nervous. So you can see, on a very, very simple example, how a business can be rocketing away, making lots and lots of sales, but its credit terms with its customers and suppliers mean that it's losing cash. All right, now you might say, okay, how can I spot this happening? All right, well, the cash flow statement is one option. All right, but some people are not very comfortable with cash flow statements. It takes them long enough to get to grips with profit and loss accounts, and they don't want to go digging around in the cash flow statement, but you could, and you'd see this starting to happen. Another place you can go is what's called the working capital section of the balance sheet. All right, a very quick way to spot a company that's overtrading, in other words, making profits but not generating cash flow from them, is to take a quick look at what's called working capital. Here's another way to cut the cake. All right, what you won't get from a company, and that's why I haven't written it up, is its credit terms. Right, most directors won't give you that information. It's commercially sensitive. They're not going to normally say in the accounts or at a public meeting, oh, by the way, 3/4 of our suppliers demand cash and the rest we get credit from. That's not the kind of information that's normally available. But on a balance sheet, you can do a very quick way of looking at this and deciding, probably there is a problem. All right, so that'll come up in the cash flow statement, fine. But what about the balance sheet? Well, here's another way to look at it. If we sold 100 million during our first trading period, right, a month for argument's sake, quite a big company, all right, and we've got a quarter of that in as cash, that means we're owed, presumably, 75 million by somebody. So when we stop the clock and draw up a balance sheet, presumably we have receivables, as the Americans would say, or debtors, as the British would say, of, well, it must be 75 million. All right, somebody out there owes us 75 million, called receivables, and it's an asset. All right, if your mate owes you £10 because you lent him £10 down the pub last night, assuming he's still around to collect it from, that's an asset until he pays you. That's the way accountants think. Right? Money due to come in is good news. Money due to go out, I'm afraid, is bad news. It's called a liability. All right, you know that if you've got a bill coming up that you haven't yet paid for electricity or something. Okay, you've got to pay it sooner or later. So basically, you could look at this and say, well, we made 80 million of purchases. Okay, we paid for 60 million, and therefore there's presumably 20 million left to go, right? Now, just to introduce another bit of jargon that accountants and other people and analysts quite like, the difference between the 75 that we're owed and the 20 million we've got to pay is 55 million, and that, in my simple example, is known as working capital. All right, and you can pick up a balance sheet, you can have a quick look at it, you can pick up the receivables figure, the payables figure, amounts due within 1 year. You can add in any stock balances, you can add in any cash, and you get something called working capital. I've just done 2 lines, all right? Now, a lot of people would say working capital, that is literally the capital working to generate our trading profits, if you like, okay, locked up in receivables, payables, stock, and so on, is good news, sort of, all right? The problem with a lot of working capital is it indicates that the business is not collecting cash efficiently. It's not managing its cash efficiently. And if you see working capital starting to rise quickly, which means receivables going up, okay, maybe payables going down, and the business is not taking full advantage of the trading terms it could. Because if you think about it, basically you don't want to offer customers a lot of credit. Ideally, you want to rein these customers in, get them to pay quicker. Commercially, you may have to offer them credit, but it's not good for a small business to have to do that. All right. So on the supplier side, ideally, as a small firm, we'd be taking credit from our suppliers for as long as possible. So if you see supplier balances shrinking away, yet the business is still growing, you've got to think, what are they doing? Okay, this is indicative of a future cash flow crisis. You know, how are they going to manage that? Where's the funding? All right. So working capital increasing rapidly, okay, in a growing business that's growing fast can indicate cash flow trouble. And the advantage of looking at working capital in the balance sheet is it gives you more information. You know, just saying, well, cash 35 million negative, we need to start to know why, okay? And working capital analysis, if you like, starts to tell you why, starts to tell you where it's gone and how the directors could rein it in, all right? So, just going to suggest in this video today that small firms, especially in the current environment, can go bust quite easily, all right? One of the reasons they do is they lose control of working capital. It's a concept that many investors and directors don't fully understand, all right? So they're surprised when it happens. Working capital is simply a consequence of credit terms largely, and the need to build up capital to trade, okay, as a small business or even as a medium or large business. So before a business goes over the cliff, all right, I'd advise you as an investor to say, great, they got some profits, what's happening to cash flow, and how are they managing working capital? Because if nothing else, it's a good question to turn up at, say, an annual general meeting of shareholders and put to the directors, do you understand where the cash is going?